any sort of respite despite the optimism from the management.
All right, Ekta, thank you very much. I mean, for now, the market is not responding to what Ekta described as sort of positive commentary on a specific line of business. Neelotpal Sahai is Head of Equities and Fund Manager at HSBC Global Asset Management. Thanks very much, Neelotpal. Great to have you back on the program. I don't know if you have any views on Divi's, which of course is one of the highest quality companies in that sector. It's a long-term sort of wealth compounder, but having troubles lately. As Ekta pointed out, earnings missed some 30, I'm talking about operating profits, missed some 30% as compared to estimates. Revenue growth was negative. What's your sense? I don't know if you own it, but if you have a view, please do share it with us.
I would be hard-pressed to comment on a particular company. In fact, I would be commenting on in this particular case as well. But the point that I guess Ekta was making is that the raw material prices has been one of the factors. So that's something that what we had seen in some other names also, and in case of chemical, which is the further upstream set of companies as well. The second point was also relevant in this case is that the volume growth which was coming on account of certain product in the previous quarter is missing in this quarter. So at the operating level also there might be a concern, but I have not seen the numbers and I wouldn't be commenting any further on this.
Neelotpal, afternoon. This is Rima here. Banks has been the consensus buy trade and the earnings are delivering to street expectations. The stocks are getting rewarded. Is it too late to get onto the bank's bandwagon right now? Do you think the stocks have already priced in a good portion of the expected earnings recovery from here on, or do you think there's still a lot of upside left?
Yeah, thanks, Rima. So we have been holding a positive view on the banks for quite some time. And initially, the key reasons for the positive view was on account of the fact that initially, in the initial part of the pandemic, there was a fear of huge loan losses, and the banks made significantly high provisions on account of that. Actual loan losses were significantly lower than what was initially expected, and as a result of which the credit cost in the subsequent quarters, last 6 to 8 quarters, has been declining, normalizing, let me say. But at this point of time, they are at decadal lows. So that is on the positive side. But from here onwards, one should expect the credit cost to actually begin to inch up to go back to the normal levels. But what has also happened in the last 12 months or so, that the credit growth has picked up after remaining subdued for almost 2 years, and now they are at robust levels, higher than the money supply in the system, and so reasonably doing well. In this quarter, we have also seen margin expansion. Now, we do reckon that a part of this margin expansion, NIM expansion that we saw in this quarter would get reversed in subsequent quarter, and that would be largely on account of the fact if the deposit mobilization competition heats up. And in this quarter, what might have happened is that the advances would have got repriced earlier than the deposit, and the margin benefit has come. Now, to answer to your question whether it's too late or not, I believe still there is a lot of steam left in the banking sector, and because the growth is still coming, the earnings growth is still robust, and this should be a key overweight. Now, having said that, the stock selection should be based on the couple of things. Because the credit growth is more or less coming, so the real differentiation will come from the fact that which are the banks which are able to mobilize deposit and at a lower cost. So that should be one key differentiation. The second one should be how adequate is their capital position, because that will determine for how longer the growth can continue. And thirdly, there are still some banks where the credit costs are still at elevated level, and that can come down, but those are more like exception. So those could be the exceptional cases and addition. So if one is selective, one will still make money in the banks and financial sector from here onwards.
All right. Hi, Neelotpal. You know, the second quarter for cement should have been a washout, and it's a washout more or less. You know, a couple of companies delivering inline set of numbers, a couple of them beating as well, but majority of the street missed estimates. You've been positive on cement, I think so. What's your view right now, and what would be your preference? would you go for the larger cap names because they are likely to get larger from here on? Or do you believe you go for the smaller ones that now have some valuation comfort?
Yeah, thanks, Nigel. Yeah, we have a positive view on cement, and that is largely because the washout quarter that you mentioned was largely known that this was, like I mentioned about the banks, that all the factors were working in favor. Here, the dispatches were weaker, the realizations were also lower, and the cost has gone high. So everything which could go wrong had gone wrong in this quarter. So that was the known part. But from here onwards, if one actually looks at, and since we also have got a positive view on the capex overall, so the demand for the cement is reasonably strong going forward. That's number one. Number two, we do believe that these margins are absolutely at the bottom level and they have to expand from here and expand meaningfully. We have also seen moderation in the pet coke prices and some of these energy prices, which will help the fuel cost and as well as freight cost moderation in case of cement companies. That will also benefit. So the outlook is better for the cement companies from what we have seen, and significantly better. It could be like one of the few cases where the third quarter is better than second quarter in terms of profitability, not something that what we have seen in the past. Having said that, the selection criteria within the sector should be predominantly, our view is the large caps, because we are seeing that consolidation is happening, and in that case, there would be a profit pool would migrate towards the consolidated players at the top, and we would prefer the large cap names within the cement pack.
What about commodities? Steel stocks have been moving up. There is a lot of hope about China reopening. The Chinese stocks have already started reacting, the Chinese markets. Is that a theme one should look at?
We have a negative view on the commodities, especially global cyclicals, and precisely for the reason that you mentioned, that a lot depends upon what is happening in China and elsewhere, on which we have got no control. Sometimes we do hear things opening up, sometimes, but there has been their zero COVID policy has ensured that the lockdowns have remained for quite some time. And since there is a lot of uncertainty about the growth angle in China as well, and a lot depends upon their policy making. So that makes it actually a little bit unsure about forecasting profitability from this sector. And that is what is keeping us away from the global cyclicals in the past. And also, and more near-term reasons actually also has been that till very recently, we were looking at the peak prices. For now, obviously, the corrections, some corrections have happened, but still they are higher than what the historical averages has been, despite the correction. So we do think that the global cyclical could correct some bit further to go back to the medium to long-term averages. We would be staying away largely from that sector.
85 points on the Nifty now, just absolutely a ripper of a day. And this is, you know, as saying this, almost an exact replica of Friday. The move on Friday started at 2:30. And we ended the way we did. And today also, basically at 2:30, the move started, and we are up 85 points, which means from the day's high, we're about 50 odd points away from the Nifty. Where is the push coming from? It's banks. So the PSU bank space was doing well, private banks not so much, but the private bank space is doing well now. ICICI Bank, if you can have the intraday up, is contributing some 16, 17 index points. Reliance is back in the mix. I mean, intradays will, I guess, tell you the story if this has happened in the last hour. ICICI Bank, yes, I think that mirrors what's happening on the Nifty. Reliance as well, maybe a little bit help from Reliance, like what we saw on Friday. HDFC Bank is the other one, which we should put up some 12 index points coming from there. And HDFC Limited also with about an 8 index odd point move. So these are sharp moves in the last 30, 40 odd minutes or so of trade, and the index is kind of flying away and doing very, very well. Neelotpal, we'll leave it there. Thank you very much for your time. Good speaking with you as always here on CNBC TV18. We'll take a quick commercial break here as well. We'll come back and get you a quick check on what's happening in dealing rooms on D Street Chatter. Buy today, sell tomorrow trades with our technical experts coming up. Stay with us.